As we step into 2025, global liquidity is making headlines for all the wrong reasons. After a year of being robust, liquidity levels have dipped below the lows of April and even the summer of 2024. In fact, we're now at the lowest readings since 2023, a shift that could signal either a looming recession or a heck of a buying opportunity. If you're interested in this sort of information, we send out a newsletter at macro-ops.com multiple times a week covering macro and different environments. You should sign up, macro-ops.com, and let's get into this one. So I did this Twitter thread on global liquidity and where we are right now in the macro environment. First thing I want to point out is the macro ops, our own global liquidity indicator. This represents how much liquidity central banks are pumping capital into the markets. You can see that in March of 2020, when the craziness happened, they really were pushing it heavy in there. Of course, we had that recession and the big rally. In 2022, 2023, we had a bear market, and you can see they were tightening liquidity after causing inflation and all that other chaos. Fast forward to 2024, that liquidity, this is global liquidity here, money being pumped into the economy by central banks around the world, pretty much since the beginning of 2024 has just stayed at max the entire time. As we come into the fourth quarter here and finish up 2024, we drop down to a pretty significant level here. So what does this mean? Let's look forward. Okay, let's see. Does that mean we have a recession? The macro ops market implied macro regime for a recession 6 months from now does not indicate that. The macro ops implied macro regime for being an overheated economy in 6 months from now does not imply that. You can see this is the implication. This is the resulting overheated economy that was in 2020. In 2021, this was suggesting an overheated economy, and you can see that until the Fed and central banks around the world put it to rest, it was an overheated economy. Right now, we do not have any indication that 6 months ahead of now is going to be an overheated economy. And the market implied macro regime for stagflation, which means inflation high and growth low, showed in 2022 the possibility of stagflation. And we can see that the summer of 2020, so at the end of 2021, the beginning of 2022, 6 months later, we did in fact get through 2022 and halfway through 2023, we did get stagflation. We had a little spike in the summer of 2023, which showed up in the first quarter of 2024. And since we do not show 6 months from now stagflation. On the contrary, the macro ops market regime is predicting the possibility of a Goldilocks market in 6 months. Now, a Goldilocks, I shouldn't say market, a Goldilocks economy, which means ISM is above 53 and a CPI of 3% or less. So high productivity and manufacturing numbers, and low inflation. That's the Goldilocks state. Now, in order to get that prediction to play out, which predicts this will happen 100% of the time, we need a 90 reading on the Goldilocks predictor. Okay, we currently are at 76%, so we have a little bit of work to do here. But if we can get above 90%, that means 6 months from now, we'll be that strong ISM and light CPI, allowing the economies to just rocket. So going back to our liquidity indicator here, this is showing central banks throwing money into the market and causing inflation, causing the market to be too hot. What they're trying to do here, because again, we're predicting the Goldilocks era in the economy in 6 months from now. What they're hoping is that they're done pumping money into the market. They're going to relax on that. They've already talked about not cutting rates anymore. China stopped pumping money into the market. Everybody's kind of calm. And what they're hoping for is the economy will strengthen. And if the economy strengthens, then they don't have to do anything. They can go back and start tightening, uh, stop pumping money into it, start making this artificial pump in the market, and they can let the economy kind of backfill that. That's what they're hoping is going to happen. So by no longer cutting rates, by easing conditions, they're hoping that the time from the that bear market we had, this almost looks identical to kind of the bull bear markets, right? They're hoping that this period will kind of, they've pulled us out of it. We've come out of the bear market, and they're hoping that the economy on its own will strengthen. Things like AI and, like I said, manufacturing, things like that will come in and strengthen the economy and allow the central banks not to continue to pump money in. So this last few days, maybe last week or two, we've had some weakness in the markets. This is the S&P 500 index, a weekly chart. Looks like we're going all the way back 2014 here. So what we have across the top is the weekly chart, the S&P 500 index, SPX. And along the bottom, you have the NYSE, New York Stock Exchange, advancing issues. And that's a 10-week simple moving average. So all you're seeing is the simple moving average and where it's going. You're not seeing the actual data. And every time that we get down into the shadow area, sometimes we have to blow through it, but when we get down into that area, it has turned into a great buying opportunity. You can see this summer, August 4th, during the yen carry trade unwind was a really good buying opportunity that happened right here. You can see in April, which was over here, that came down into that area. Back in late 2023, that turned out being a pretty good area. This would have been at the beginning of 2023, right after Silicon Valley Bank was rescued. And then this would have been a major market signal bottom in September, October of 2022, which is when that kicked off the beginnings of the new bull market. Kind of not all that great through this post March 2020 era, through the bottom of the bull market or bear market there. It didn't really give us a whole lot of information. You can see that, it worked here and there. But it really worked at the March 2020 bottom. It really worked at the December 2018 bottom. It really worked back at the end of 2016, the beginning of 2016, after the Chinese, the commodity issues that kind of like stagnated for a couple of years. And so right now we have that nice idea of, look, if you're looking to buy, this is a great time to buy. If you're looking to be scared, this is not the time to be scared. A lot of times what we need in life is not a reminder to run away, but a reminder to be like, okay, this is the time where we want to be taking, if we're out shopping for stocks or riskier assets, this is the time to be looking at that. And so we're there. We got the buy signal on this one. This is the nervous and numb signal, the macro ops nervous and numb signal. And it's giving us a major buy signal. This measures the difference between the S&P 500 and the VIX, volatility index, relative moves. And when we get down to these levels, we get a major buy signal. You can see any of these green lines, which this is our current buy signal in the S&P. We had it at the end of 2023. We had it the beginning, a little bit at the beginning of 2021. It looks like the bottom, the March 2020 bottom, the heading into at 2019, when we kind of got done with all the easing and they just said, let's go, heading into the March 2020. And then, of course, down at the December 2018 bear market bottom. So we got some really good signals on those. You can also notice that this has top signals. So when the SPX versus VIX relative move is at an upward extreme. That's a major market top. You can see that we topped. And by the way, major market top's the wrong word. A top happens. Okay. So, you have the like end of Q3, Q4 in 2023, we had a 15-20% pullback. We had a smaller one in 2024 during the April. We had the big one at the end of 2021, which kind of was the top before that 2-year, year and a half bear market there. We've had multiple opportunities, right at the beginning of March 2020, right when markets tumbled, right there. It didn't catch the 2018, but it's done really good. So we just issued a full-on bull buy signal on the S&P. So we've got multiple buy signals on these big long-term indicators that say, hey, this is when you want to be stepping in to buy stocks. Back to our liquidity indicator representing liquidity being injected in the market from central banks, we can see that Bitcoin actually is kind of really good at showing, like the effects of this liquidity. You can see back in 2016, this marked the beginning of the crypto bull market in 2016, and it lasted until the end of 2017. We go from $500 on Bitcoin to 20,000 through that period. Okay, and we go through a bear market. Again, we've got liquidity. So right here, the 2020, March 2020, the thing that happened that will not be named. When the Bitcoin rally begins in 2020, you can see the liquidity indicator has us up at pretty high levels, and the end of that crypto bull market in November 2021 as we dip down to those levels. Again, you can see the October 2023 is when the crypto momentum system got long crypto, and we are still in it. And you can see that this momentum, the liquidity indicator has held through that period of time. Or questions about what we talked about here, put them down in the comment section down below. I'd love to give you an answer. Give me a follow on Twitter at Chris D Macro, and sign up for our newsletter at macro-ops.com. Love you all. Bye.